History has no shortage of men like me claiming that everything is a giant bubble about to pop. But on the other hand, for every prediction of doom and gloom, there is an equal force proclaiming we are in a new bull market and things are set to go higher and higher from here. Sometimes the bulls get it famously wrong. The best example of this is probably Irving Fisher predicting that stock prices had reached a permanently higher plateau and having his quote published in the New York Times on October 16th, 1929, which was literally 2 weeks before the stock market crashed in 1929, leading to the Great Depression. And it would take over 20 years for the stock market to come back to a new all-time high. But obviously, sometimes the bears get it wrong too. Like this prediction on CNBC from 2011 that the Dow would fall to just 3,000. And this prediction was made in 2011, just a few years after the stock market had already crashed over 50% from the financial crisis. So the question is, where are we right now? Have we entered into a new global bull market, or has an everything bubble just formed and is ready to pop? Well, somebody very wise once said, if everything is a bubble, nothing is.
Everyone can be super. And when everyone's super, no one will be.
No, but really, if everything does look like it's in a major bubble, then likely something else entirely is going on. First, let's take a look at what's going on with gold. After the money printing started, gold rallied all the way from about $14.50 an ounce all the way up to over $2,000 per ounce. In the subsequent crash, it fell back down to about $1,600, but ever since then, it's been rallying. It has broken through old resistance to new all-time highs, currently trading around $2,160 per ounce. Bitcoin has a similar pattern. After the money printing started, rallied all the way up to about $65,000, and then in the subsequent crash, it fell all the way down to around $16,000. Since then, the rally has taken it up to new all-time highs, currently trading right around $71,000. The S&P 500 has a similar pattern. After the money printing started, the S&P 500 rallied to a high of 4,800. In the subsequent crash, fell all the way down to a low of 3,480, and since then has recovered and broken out to new all-time highs, currently trading at 5,150. And finally, we have to look at real estate. If we take a look at the median sales price of a home sold in the United States, you'll see that after the money printing started, home prices went from about $322,000 at the median up to a high of $479,000. We've had a little bit of a correction there in home prices, sitting around $417,000 for the median sale price right now. Since there are multiple ways to measure the housing market, we can also take a look at all transactions house price index for the US, and we can see that it went from a level of 454 when the money printing started to a current high of 657, with only a slight blip down around the 622 mark. So what's the problem? Everything is hitting new all-time highs. There are going to be some people looking at this and saying, this is confirmation we're in a new bull market. We had the volatility, we had the crash, the correction, the sell-off. Now the fact that we're rallying from here means we have strength ahead. But you also have an equally valid argument on the other side saying, last time prices were this high, everything was so expensive that the crash was absolutely destined to happen. Fundamentally, nothing has changed. Therefore, just as prices were too expensive last time, prices are too expensive this time. So let's throw another curveball at this situation and take a look at one major difference this time than we had last time when asset prices were this high. This is the Federal Reserve's balance sheet and shows us when the Federal Reserve is either engaging in quantitative easing or quantitative tightening. All the time periods when the balance sheet is moving up higher, like it did in 2008, 2011, 2012, and 13, and most recently and most extremely in 2020 and 2021. This process of quantitative easing means the Federal Reserve is printing money to buy assets out of the financial system. That newly printed money works its way throughout the financial system and the economy, bidding up the prices of assets first and then goods and services. On the other hand, when the Federal Reserve's balance sheet is moving down, they are engaging in quantitative tightening like they did in 2018 and 2019, and like they've been doing ever since 2022. This is the exact opposite, where the Federal Reserve allows assets to bleed off of its balance sheet, which means as those bonds get paid back, the Fed does not roll them over, but those dollars cease to exist. This sucks money and liquidity out of the financial system, which, all else being equal, should push asset prices and goods and services down. And that's obviously the reason the Fed has been doing this, is because they've been trying to fight inflation so they can bring it down to where they want at 2%. The other thing the Federal Reserve has been doing is keeping interest rates high. The federal funds rate has stayed at 5.3% since August, when they first got it there, despite the expectations from the market that the Federal Reserve should or would cut. They have kept it steady. So the two actions by the Federal Reserve right now are quantitative tightening and keeping interest rates high. These are in stark contrast to what they were doing in 2020 and 2021, the last time asset prices were at their current levels. That made sense for 2020 and 2021 because the Federal Reserve was printing money and quantitative easing like never before. At the same time, interest rates were literally zero. But this time, the Federal Reserve is engaging in quantitative tightening, and interest rates are over 5.3%. And you could say, well, these are not the only factors that affect the total money supply. We could see liquidity conditions increasing, even if it's not from the Fed. And you would be right, except for the fact that the money supply is not increasing right now. Clearly, we got a giant increase in 2020 and all the way through 2021, but that stopped in April of 2022 as the money supply started to decrease from there. And if we zoom in a little bit, we can see that the decline in the money supply has slowed down a bit. And if we zoom in even more, we can see that over the last couple of months, the money supply did actually increase a tiny bit. But zooming back out, we can see this is absolutely nothing in comparison to what happened in 2020 and 2021, meaning it should not be able to be responsible for this massive rally in asset prices from the NASDAQ to the S&P 500 to Bitcoin to gold. Something else is going on here. And that other thing that is taking place right now actually at first makes this even more confusing, that we are looking at something that looks like an everything bubble right before our eyes. And that piece of the puzzle is that the US government is on a deflationary crash course. The national debt just hit $34.4 trillion. Right on cue, Biden announces a $7.3 trillion spending plan. Already this year, the deficit is 16% higher than it was during the same period last year. And that's impressive considering revenue is also up 8% more than it was last year, the same period. Just as the government proves every single year, it is not an income problem. Every single year they take more in taxes, but they end up spending even more than that, increasing the deficit and mortgaging our futures instead. As a result, interest payments alone on the national debt are already well over $1 trillion per year, which means that we can read the writing on the wall and we can see the government barreling forward towards a deflationary crash, a default. They will run out of money to borrow. This is because for every dollar they have already borrowed, they have to borrow more dollars than that just to pay it back, plus the interest, and keep on spending their higher spending amount. But every dollar they borrow right now to continue that going means they have to borrow more dollars in the future. This is a snake eating itself by the tail. Eventually, you just run out of dollars to borrow. Now, this should be pushing asset prices down, because if this plays out, money ceases to exist. It disappears from circulation. That's what a deflationary crash is. It's defaults, it's deflation, it's prices crashing because the money supply decreases. But you know what's up. They've been here before, and they do the same thing every time. They print. QE is coming back, but not lower rates. Here's why. Back in 2019, the repo market blew up. We don't need to get into the details of what happened during that time, but essentially the interest rate to borrow money overnight from one bank to another skyrocketed because there was no cash available in the system. All the available dollars had been soaked up by the US government because the US government had gone on a borrowing and a spending binge. It had sucked all of the remaining liquidity out of the financial system. There were no more dollars left, so when banks went to each other in the middle of the night to get cash, there wasn't any, so interest rates skyrocketed. The Fed handled this by, wait for it, that's right, not QE, by increasing their balance sheet and saying that it wasn't QE because they were just doing it to bail out the repo market. But remember what we talked about earlier. If the Federal Reserve is printing money to buy assets out of the financial system, which increases its balance sheet, that is quantitative easing. And that's exactly what they did starting in September of 2019 to bail out the repo market. Just like happened in 2019. The government borrowed all the available cash out of the system. There was no more cash left. The system started to blow up. The Fed intervened. They printed money to buy assets out of the financial system, replace it with cash so the banks would have cash, ultimately to lend back to the US government. It's the same playbook they always use, and they'll use it again. Okay, so now with that understanding, let's look again at asset prices, but let's measure them differently so we can see this from a different perspective. This is a chart of the S&P 500 going all the way back to 1885. But you're gonna notice something different about this chart. First, you'll notice that it doesn't just go up and to the right. And that's because we're not pricing the S&P 500 in dollars here. We're pricing the S&P 500 in gold, which shows that when you price the S&P 500 in gold, not only are stocks not at all-time highs, but they're also not insanely overvalued right now. In fact, stocks priced in gold right now are at the same level they were at all the way back in the 1960s. And it's not just stocks. This is a chart of the US Case-Shiller Home Price Index, again, priced in gold, going back to the year 2000. And you can see that priced in gold, US home prices are well below their old pre-financial crisis high and are in fact, historically speaking, extremely reasonable and probably have room to run up. Okay, so why are we looking at this? Because number one, whenever anybody says something is expensive, you have to say compared to what? Usually people are just comparing it to dollars. They're saying it used to take this many dollars to buy something and now it takes this many dollars to buy something. But when you use that measurement, if everything across the board is more expensive, then something else is probably going on. Number two, this shows that what we are seeing in terms of asset prices is not actually crazy from the standpoint of inflation. The purchasing power of gold is very stable over time. You can buy pretty much the same amount of stuff today with an ounce of gold as you could 100 years ago, 300 years ago, 1,000 years ago, which means that even during the short term, it's a decent proxy for real inflation. And if your asset prices are getting more expensive in terms of dollars, but not in terms of gold, then you're probably not looking at a bubble. You're probably just looking at asset price inflation from money printing. But you say, we are not experiencing money printing, so why are asset prices flying up right now? It made sense in 2020 and 2021, but why now? Well, because the government is running out of money to borrow. They're paying more and more of their total income towards just the interest on the debt, and that's as interest rates on new debt continue to climb. Every dollar they borrowed in the past means more dollars they have to borrow today, and every dollar they borrow today means more dollars they have to borrow in the future. It's a matter of time until they have no more dollars left to borrow, at which point they would default, but we know before we get to that point, they print. The Federal Reserve prints money to loan it to the US government. The government then spends it into existence, pushing up the price of goods and services for all of us as a result. This means that the reason why we are seeing an everything bubble, where prices across the board are all flying higher, wealth is protecting itself from inflation before it happens. And by the way, if you're not confident that your portfolio is safe from inflation, sovereign debt crises, flash crashes, all the coming economic storms, I'd love to help you out with that. Join my program, Heresy Financial University. I'll teach you everything you need to know: how to bulletproof your portfolio, how to explode your income, how to beat inflation, how to identify assets that are actually on sale, and much, much more. You get access to over 49 hours worth of video training material every month, live group coaching calls with me, access to the Heresy Financial community, and much more. You don't want to miss out on profiting from everything happening right now, but you also don't want to risk blowing up your portfolio by going too big on the wrong thing at the wrong time. I can help. Join now, link is in the description. Now, most people probably don't remember this, but asset prices going up before inflation actually hits is the same thing that happened last time as well. It was March of 2021 before the inflation rate got back up to 2.6% where it had been before. By March of 2021, the price of gold had already rallied to an all-time high and then corrected. And by March of 2021, Bitcoin had also already rallied to basically its all-time high. And by March of 2021, the S&P 500 had also already fully recovered from its crash and rallied higher and higher. And there was still a little bit that it went on to make that was also erased after the crash. And the exact same thing with the NASDAQ. By March of 2021, it had already recovered from its crash and made new all-time high. And then ultimately that was erased as well during the subsequent crash. So just like last time, asset prices are right now rallying in anticipation of the inevitable coming wave of inflation. There is no way out of the fiscal problem we're facing without printing. Either the government defaults or the Fed prints. And that printing will cause prices of everything to go up, which is why wealth right now is trading dollars for assets. Now, there will certainly be volatility. A flash crash is almost guaranteed to hit stocks at some point, I think, this year. That will be triggered by the unwind of the current gamma squeeze, which is pushing stocks higher. I can make a video on that if you'd like, let me know. But look at the Venezuelan stock market that took place during their hyperinflation. Yes, there were crashes, but ultimately it went much higher. And overall, Venezuelan stocks performed way better than their currency. Now, it's also possible that the Federal Reserve does not return directly to pure quantitative easing. Instead, they might make banks take their place, performing a stealth QE through banks instead of on their own balance sheet. And this may be the reason the Federal Reserve has recently been considering changing the leverage rules for banks, specifically with treasuries, meaning that banks in the future may be able to buy an unlimited amount of US treasuries. And yes, banks would be printing the money into existence to buy those treasuries. Same result, but because it's not on the Fed's balance sheet, the average person would not take notice of it. And I can make a video on that as well if you'd like me to. In summary, the everything bubble is most likely a move by wealth to avoid future inflation from the coming money printing to help solve the fiscal crisis. The government is borrowing and spending way more money than they should be, and they're not slowing down. At some point, they will be forced to slow down by a default unless printing occurs first. Betting on that printing to happen instead of the default, wealth is moving into assets to protect itself from that inflation. And if you'd like me to help you do the same, join Heresy Financial University. Link is in the description below. As always, thanks for watching. Have a great day.